All right, so tonight we're going to do a webinar that we do about 6 to 8 times a year, depending on the schedule, called How to Self-Direct Your IRA into Real Estate. And it's a live webinar presented by me, Aaron Fragnito, one of the owners of People's Capital Group. We're going to talk about how we work with private investors and how we help people self-direct their IRA or solo 401k into real estate, and the types of buildings we buy with them and how it works working with passive investors investing through People's Capital Group into high demand real estate. So this will be about a 30-minute presentation here tonight. If you have any questions as we go along, please type them in the Q&A. I see more people jumping on here. It's good to see. We also are live on YouTube right now, actually. We usually go live on Facebook. We switched it up with YouTube. So we'll be answering any questions here at the end. You can type those in the Q&A. We'll go over the process of how to get qualified as well at the end of the presentation. So our mission tonight and in general is to transform personal finances and quality of life by creating passive income streams through real estate investments. So Seth Martinez and I have been doing this about 10 years each. We've been helping people invest in real estate. We incorporated in 2013 with People's Capital Group, and we've accumulated a nice amount of wealth by helping people invest and also really finding mismanaged properties, improving the management of them with our in-house management company, repositioning them and refinancing over time. So we'll break into that model of the buy, renovate, refinance structure tonight and how we do that with apartment buildings in New Jersey and why we do that as well. But the reason I got into real estate and started building my wealth through real estate was I actually read a book called Rich Dad Poor Dad. If you haven't read it, check it out. You've probably heard of it. And in that book, Robert Kiyosaki, the author, writes, at the moment you make passive income and portfolio income a part of your life will change. And that is true. I find that making your money work for you is a big decision people can make. And when people start really putting their money to work and taking control of their finances, you see changes for sure. Absolutely. So we help sophisticated and accredited investors invest in real estate and self-direct their IRA into that. So in 2013, we incorporated here. Seth Martinez there on the left. That's me on the right, Aaron Fragnito. And Seth had actually sold a medical billing company and then got into real estate. I was a realtor, and we teamed up together. And together we've done about 250 plus transactions. We've wholesaled properties. We've fixed and flipped properties. We've bought and sold apartment buildings. And our main focus today is raising capital and holding on to apartment buildings and managing them with our in-house management company, and allows our passive investors to make cash flow on the property, tax depreciation through a K-1 tax form at the end of the year, and equity growth over time, which is the main moneymaker with New Jersey real estate. The equity growth over time, we refinance, we harvest that equity growth, and that's how we pay our investors lump sums of capital every 4 years or so in our investments. And we'll explain how that works with IRA investors as well, and tax benefits of investing through the IRA, of course. So our agenda tonight: why do people invest in New Jersey apartment buildings? Why do we focus on New Jersey? Some of the benefits of that. Number two, why do we do the syndicate? Why do people prefer syndicated investing, pooling capital together and buying a larger building? Number three, why do people value our service here, People's Capital Group, our in-house management, our turnkey system to invest in New Jersey properties? And we'll kind of talk about how that experience is for our many passive investors. So we're going to touch on the COVID here real quick. Obviously, this has had an effect on our market. It's actually boosted property values right now, and we've seen a nice amount of market growth over the last couple of years here. We are no longer investing in single-family properties and flipping single-family homes. That's just too saturated a market. There's just no inventory right now. Also, the cost of renovation has really increased, which makes it very hard to profit on flips. We focus on apartment buildings. That's our main bread and butter. We buy, renovate, and then refinance mismanaged apartment buildings. We turn them into performing assets with our in-house management company, and we focus on the North Jersey market. Self-storage is a space we are trying to get into. We like that space a lot. We think there's a lot of growth there. Office and industrial, we are not bullish on. Office has been nailed by the COVID here, and industrial, we are looking into certain times, but it's really not our specialty. We like assets where people need a roof over their head, where people live, residential real estate, apartment buildings, especially in high demand markets within an hour of Manhattan. That's our recipe for success. So we don't focus on retail or too much in the hospitality and senior housing space. Although that last one, hospitality and senior housing, we are open to entering in the future. There's a lot of growth there. But our focus is apartment buildings in North Jersey. And we help people invest in those buildings. It's hard to find a really good deal. Usually when we find one, it gets filled up pretty quickly through our passive investor group. And for those investors, when they're looking for a good syndicate to invest in, right? That's what we are, a real estate syndicate. So when you're looking for a strong syndicate to invest in, the first step is educating yourself on how it works investing in real estate. Do you want to be an active investor, run around calling the shots, dealing with contractors and realtors and tenants or property managers? Or do you want to work with experienced professionals that have experience doing that, have the infrastructure in place, the boots on the ground, the team in place to do real estate the right way, manage real estate the right way? Because real estate is a very management intensive business, right? Buying an apartment building is not like buying a stock necessarily. So if you're the operator, by buying an apartment building has a lot of responsibility. Investing in a stock does not. But the idea of real estate is that investing with experienced professionals through a syndicate is a very smart way to go for people that don't have the time to deal with all the shenanigans of being a landlord or any interest in doing it either, because it's really a preferred taste and it takes experience to do it the right way, or you end up losing money and learning the hard way. So things to take into consideration when you're looking for the right market, history of the market. Do you want a market that has long, consistent growth in the past? That's one of the reasons we like the North Jersey market, where we work off that New York City borough, but we don't invest in New York City. We focus on the North Jersey market that just holds strong demand through thick and thin. Also degree of risk, right? You could do ground up construction on beachfront properties in Miami or things like that. It would be a higher risk investment with a higher reward. So you want to look into options there. But also location, right? Investing where you live, does that matter to you? If you're really not doing the management, it doesn't matter. We have investors all over the country that invest with us, but the majority of the people that invest with us are local because they like investing in local cities. They know Newark, New Jersey, Paterson, Rahway, Essex County, Morris County. They know these areas, Union County. They grew up around here, so they like investing in those cities. They believe in those cities, and they see their money making a difference in a lot of inner city areas. And that's what a lot of our IRA investors especially like, is that when we buy a building in Paterson, New Jersey or Newark, New Jersey, and we renovate it and make it a better place to live and a cleaner place and smells better and safer place to raise your family, our investors really like that. It feels good to them to see their IRA make a difference, their solo 401k be self-directed into real estate and really make a difference and actually improve a city and make a small difference. That little section, right? That little block of real estate, you can make a small difference there. You can maybe make a larger difference in the city through time. So one of the reasons we like investing in real estate in New Jersey is because the wage growth is consistent here. Rental growth is consistent. We really don't have much trouble renting out our units. We find that the hardest part of our job is finding a discounted apartment building for sale. And once we find a good apartment building for sale, we put out to our investor group. It generally is funded very quickly. Right now, New Jersey is one of the highest skilled workforce. They ranks number 1 in education, number 3 in median household income. 20 Fortune 500 companies are in New Jersey, number 1 in drugs and pharmaceutical jobs, number 2 in direct foreign investments. So New Jersey is a hub of activity. There's so many people living in New Jersey that need a place to live. There's such a lack of housing right now. If you own the real estate, you're really in a good position. With inflation going up, the cost of debt is going down, the value of our real estate is going up. So we see that right now, being the landlord is a good position to be in, and our investors are doing quite well with our investments. We're achieving our refinances sooner than targeted because we put very conservative targets and projections when we first buy a property, and the market has done better than our conservative projections. And we've also done well on our end as well. That has allowed for us to achieve our goals faster for our investors and get them stronger returns in this strong market we've experienced. We'd like to see that. So why do people invest in New Jersey apartment buildings? Why do people self-direct their IRA or solo 401k into that? And we're going to break into that more on how that works. The first part of this presentation is more about the real estate into the business, People's Capital Group, buying, renovating, refinancing apartment buildings, how that works. And then we'll break into the section about how to actually self-direct your IRA. It's quite simple. It's just a couple steps. And we'll talk about that and how that works towards the end of the presentation. I see more people are jumping on as well as we go. That's always good to see. Again, if we have questions, you can put them in the Q&A. If there's any technical difficulties, please let me know as well. So why do people invest in New Jersey apartment buildings? So people want legal tax shelters, predictable investment returns. Real estate tends to be more predictable, slower moving than the stock market. The market's been very volatile recently. We've seen the stock market go up and down a lot in just the last couple of days. And the scary thing is most people keep the majority or 100% of their retirement portfolio in the stock market. Now, you can be diversified within the stock market. I completely understand that. But in my opinion, true diversification means taking some of your IRA or solo 401k and some of your capital and investing it into well-managed, professionally managed real estate in high demand markets. It doesn't have to be People's Capital Group, doesn't have to be New Jersey, but a real estate syndicate that's well run, that has a history of performance for their investors. And do their investors continue to reinvest? That's an important question to ask the syndicator. And if so, move some capital into real estate, because I do feel that being 100% invested in the stock market is not true diversification. Even owning REITs, which are stocks backed by real estate, that's not really getting out of the stock market. Essentially actually self-directing your IRA into a well-managed piece of real estate or collection of buildings through a real estate syndicate is actual diversification into real estate. So the reason people do that is they're looking for lower risk investments. They like the idea of getting the bigger apartments, apartment buildings. More units are better under one roof. With with more units, we are hindered less by vacancies and repairs. And of course, the New Jersey market's very high demand. So most real estate syndicates don't have in-house management like us, and also don't invest in New Jersey. So we've really focused on New Jersey. It is very hard to find a deal. You have to understand the red tape, rent control. It's not a landlord-friendly state, so you have to work with all the resources that are there for tenants and landlords. And but we make sure we have our infrastructure here in New Jersey to perform properly, and we find it as a great market to invest in. Very strong demand. It's a very high competition market. You really got to know. It's about who you know a lot of times in New Jersey. So well-managed New Jersey apartment buildings do tend to fare well in recession. We find that through tougher times, you can still collect rent on properties, especially in high demand locations, as we help tenants get in touch with different ways to pay rent through nonprofits or government assistance. And therefore, it seems to be a stronger long-term investment for a lot of people that doesn't go up and down with so much volatility as well. And of course, real estate offers tax appreciation and lower other forms of income. I see we have a question here. Okay, that's good. We'll answer at the end. And also, why do our investors like New Jersey here? Why do they like investing in apartment buildings with a long-term strategy? It's quite simple. Once you're investing in a good asset with good operators, you want to continue that investment and allow it to fund important occasions in life, like putting your kids through college and weddings, travel. It's a completely passive investment. You don't have to run around and deal with the headaches of being a landlord or a property manager. That's our job. And however, you can get into high demand properties and, of course, use those returns, the passive income, to live a more enjoyable lifetime and support your family as well. That's the whole idea of a passive income. Not have to work for your money. Make sure your money is working for you, because we work too hard for our money for it to not be working harder than us. So as I was saying, our investors like low risk investments. By spreading out the rental income amongst many units, you lower the risk, right? Owning a 50 unit or a 25 unit apartment building is better than owning a 2 unit or a 3 unit property. If you lose one of your tenants on a duplex, a 2 unit, then you lose half your income. You're gonna have trouble paying the mortgage possibly. On let's say the heater breaks, the $5,000 replacement of a boiler. It happens all the time in real estate, unfortunately. And that could be a cost that could really hinder your income. If you're making maybe $5,000 in complete net profit through the year, like a duplexes may make, then that additional cost can destroy all of your profit, eat up all your profits. So more units under one roof, economies of scale, are very valuable in real estate. So we focus on buying bigger properties, so investors can get started with as little as $30,000, but get into multi-million-dollar buildings that are safer investments. And that's why real estate syndicates make a lot of sense for people. And of course, we personally guarantee the mortgage sometimes if we have to, so our investors don't have to. If you've ever bought a home, you've probably had to personally guarantee the mortgage. That's a huge amount of risk. Seth and I take that on so our investors don't have to. I see more questions coming in. Feel free to put them in the Q&A there if you can. So we focus on, like I said, North Jersey. We do not do South Jersey. We focus on properties that are within an hour of Manhattan, generally near a train station that can get you into Manhattan within an hour or so. downtown areas. We're very active in Newark, Passaic, New Jersey, Paterson, New Jersey. We just closed on a property in Rahway, New Jersey, and we focus on renovating the units and renting them out for top dollar to quality tenants. And we like doing that in areas where there's a lot of growth potential as well. Downtown Newark, we've done phenomenally through the years around the university there. We see the same thing happening in parts of Paterson right now and other parts of Union and Essex County also. So number two, why do people prefer syndicated investing, right? Pooling capital together. Why is that a preference? Why is that a better strategy than perhaps buying a smaller property yourself and being fully in control of the property? Well, it's quite simple. People don't want to manage the property. And even if you do want to manage property, it's really not a very fun job. It's quite an acquired taste. It's quite a thankless job as well. Even when it's done well, it's not like your tenants are like, oh, thank you for collecting my rent on time. So it's a tough job. We found that it's very detail oriented too. I think one of the hardest things Seth Martinez, my business partner, and I have done is actually create our property management company. It's been extremely difficult. It's taken many years of trial and error, going through contractors and service providers, creating the right team of professionals to really take a completely mismanaged property. The building we just bought had rents 30% below market value, needs about $350,000 in renovations. So something like that is a really big job. It's a really big reposition. And most property management companies are not going to be able to actually complete that project for you, or take a mismanaged building with a number of vacancies or non-performing tenants and work with those tenants, or take some to court, or work out cash for keys and complete renovations, get them rented out for top dollar. And of course, do this all at a discounted property management fee, which is what our property management company does. It charges about 2/3 of what your average property management company would charge. So it's really a very good asset for us. It's not a profit center for us. It's a tool. It allows us to have better control of our assets, get better performance out of our buildings, so our investors do better in the long run as well. So, of course, our investors like the idea of tapping into expert knowledge, using our years of experience and learning from our mistakes, learning from my monthly updates, quarterly financials. And it's taken us years to get here, but now we can bring that knowledge to our investor base and exercise it on project after project here in North Jersey. And of course, people value their free time, not having to secure the complex financing. Our relationships with banks is very complex. Getting good mortgages at good rates is very important in this business, and that's very complex into the business. That's taken years to procure those relationships. So putting this all together, it allows us to perform a nice syndicate for our investor group. So when we buy the property, we force equity appreciation into the property. That means putting actual capital renovations into it, renegotiating leases with our management company, working with certain tenants, doing cash for keys with other tenants, and executing all the things we need to do to increase the rent on the building, lower our expenses if possible as well. And this creates more positive cash flow for our investors, of course. And the more positive cash flow a building creates, the more it's worth, right? An apartment building's value, just like a business, the more it makes, the more the net operating income is at the end of the year, the more the building is worth. So this allows us to increase the value of the property as we increase the cash flow from the building. And over about a 3 to 5 year period, we're going to then go ahead and do a refinance of the building. It's called a cash out refinance. The building's worth a lot more money after improving it for a number of years and increasing the rent roll on it. So we're going to go ahead and get a higher mortgage amount, not too much of a mortgage amount. The bank's going to limit us, of course, to whatever cash flow the building can support. And then we're going to go ahead and pay off the old mortgage. There'll be cash left over in between. That's called a cash out refinance. That cash is then distributed to the investors and ourselves according to our equity ownership. And that allows us to pay our investors and pay ourselves and take some equity off the table, take some cash off the table, but not necessarily sell the building, right? We're not selling the building. It's not cash flow. This is debt. It's good debt. It's low interest debt that's going to be paid down by our tenants for years to come. It's debt that's possibly personally guaranteed by Seth and I, so our investors don't have to. And but that debt allows us to pay our investors tax-free as long as they stay invested in the opportunity. We plan on doing that refinance every 4 years or so. By year 8, ideally, our investors have made back their entire investment. That's always our goal. And of course, there's quarterly cash flow checks along the way as well. But in North Jersey, the majority of the return of the investment comes from the refinance. And that's where we try to get about half of our investors' capital back at each refinance. So that's the buy, renovate, refinance strategy. We do sell buildings sometimes. We really prefer not to. That's definitely not plan A. Because of that, we really have a long-term view of real estate. We plan on eventually selling maybe a few buildings 15 years down the road or so once we exhaust a lot of the tax depreciation and, of course, force value into it over a number of years, and perhaps trading into a much bigger building through a 1031 tax deference that allows us to defer all taxes, trade into a bigger building that produces better returns over time. So really a long-term view of real estate. But of course, our investors have exit options along the way, and we'll go into those in a second as well. They can exit at each refinance and get back their initial investment if they choose to exit the investment. So over time, we've invested up to $10,000 a month sometimes to find the best deal. We'll look at hundreds of properties to find one mismanaged building in New Jersey. It's to get the right price. That's very tough to do off market generally. These are not properties on LoopNet or CoStar. That's really not where the deals are. And we have 10,000 plus people in our network of real estate investors, people in the business, people outside of the industry, just people we've worked with for years, people that follow us and learn from us as we do podcasts every single week. We have thousands of people in our meetup groups. We have in-office events as well that we just started up again, which are sold out quite quickly. And we'll be doing another one of those in March that you'll be invited to if you fill out the application form on our website there. So we've secured funding on over 250 properties. We've have about $20 million in assets right now, about 150 doors. And of course, as I was saying earlier, with the strategy of securing the mortgage on the property, we're able to leverage the capital we're raising from our investors, and that allows us to produce better cash flow from the building and allows us to do that cash out refinance over time. All right, so let's break into number 3. Why do people value PCG's service here? We're going to talk about our aggressive calculating business model and our in-house management company here, break into that a little bit, and then we'll go into the IRA side of the presentation here. Again, if there's any more questions, keep putting them in the Q&A there. It's a good spot to put them. So we invest a lot of capital every month to find good opportunities. We talk to landlords, property managers, brokers. We get pocket listings, wholesalers, and looking at all the deals, we cherry pick the best ones that have rents below market value, need some cosmetic improvements. We're really looking for lipstick on a pig is a scientific term there. We are not looking for buildings that are falling in on themselves or completely vacant or complete disasters. At the right price, we wouldn't turn that down. But our main bread and butter is just simply mismanaged properties. This 27 unit we just bought in Rahway, New Jersey, the rents are about 30% below market value. But the units really just need cosmetic improvements. We are going to put kitchenettes in the studio apartments, but overall, it really is mostly a cosmetic improvement throughout the entire building for all the units, inside and out, the common area as well. So there's a lot of work to do, but we focus on that type of renovation because we're not putting additions on properties. We're not building ground up. There's a lot less risk when you're buying an existing property and renovating it as such, and just bringing it up to code, making it nice and new so it rents for top dollar. Of course, that's the goal of all of our units. So syndicated investing pools money for better returns. As I was saying earlier, investors can get started with as little as $30,000 in multi-million-dollar buildings, and bigger is better in real estate. It's easier to make profit through the cash flow, through the cash out refinance with bigger buildings than it is with smaller buildings. So ideally, we manage the property day in and day out with the exit strategy there, with the refinance strategy where the investors can exit at each refinance if they choose to, or remain invested long-term with us. And that allows for passive income streams, the quarterly cash flow on the building once it's up and running. And of course, the cash out refinance every few years as well. So the goal here is to increase the net cash flow, which increases the property value. That's going to increase the equity. Equity is the amount the property is worth minus the debt. That's going to increase your cash from the refinance, and that'll increase the tax-free income to investors. Now, of course, when investing through an IRA or solo 401k, the funds you're earning, if you exit the investment, will be tax deferred as well if done properly on your end. But of course, this is in general for a cash investment. The cash out refinance strategy is a very good way to defer taxes. And of course, the less money you pay to the IRS, the more money you keep. So the reason we do this, it's a tax strategy. It allows our investors to get higher internal rates of return up around the mid to high teens, double-digit cash on cash returns with the cash out refinance strategy. And so it's really a tax strategy and an equity growth strategy, a wealth growth strategy here with the refinance, cash out refinance. So we have an aggressive and successful repositioning track record. We are laser focused on this North Jersey market. We don't manage anyone else's properties but our own with our management company. We keep our construction costs as calculated and within budget as possible. It's very important to have good contractors on your team. We don't give our contractors out to anyone. We hold them very close to the belt. If you have a good contractor, don't give them out to anyone. Hold them close to the belt, because once you give them away, they're going to get too busy. And of course, we work to create that consistent cash flow. And the goal is day in and day out to increase the cash flow, to increase the value of the building, and eventually get to that refinance strategy, refinance point every 4 years or so. And then the investors have two options here. All right, so we get to the refinance. You can stay invested in the LLC, continue to get that quarterly cash flow check, continue to get the refinance capital every 4 or 5 years, monthly updates, quarterly financials. Or you can sell your shares, ownership in the LLC, get back your initial investment, keep the funds from the refinance, keep the funds earned from the cash flow, but now you've exited the investment, so you're no longer earn returns from the investment. You've got back your initial investment plus the profits. But you're going to, if you're not investing through an IRA or solo 401k, you then would have to pay capital gains tax. If you are investing through a solo 401k or an IRA, then ideally you're going to defer those taxes. So that's the whole point of investing through an IRA or solo 401k, is to not pay taxes on exiting the investment. And of course, either option makes sense, really, aside from the tax benefits there. I mean, really, if you're not going to get taxed on exiting, you can. But once we have the building up and running, 9 out of 10 of our investors choose to stay invested long term. Not only is it a smart tax strategy, but even if you're investing through an IRA, it makes sense, because once the building's up and running, we're done with the renovation. That takes a couple of years sometimes to get the building up and running, get the cash flow producing from the building. Depending on the size of the renovation, it can take up to 3 years to get a building to positive cash flow. So once we're there and we're cash flowing, we get the refinance done, it makes a lot of sense to stay in the investment as we're growing and growing from that point, and we have that long-term view of real estate. So people like that, especially if you're investing with a retirement account and kind of a long-term view for that account. So together we've pulled over $7.5 million of capital here. We need to update our presentation. And we work with a minimum investment of $30,000, about a 3 to 5 year minimum investment period that our investors agreed to. And we're also looking for a good fit. We have over 50 investors in our network that currently invest with us as passive investors. And it's important to understand that you're a passive investor, you're hiring a team of professionals to do the work day in and day out. And that's why we offer a lot of updates and a lot of details to our investors. It's important you're kept abreast to what's going on, not just every 3 or 4 months, but every month I send out an update. And I think that's important to do. And of course, we leverage our investors' capital, generally about 70 to 75% LTV. Loan depends on the property. Every property is a little different. So we're going to go over a couple of quick case studies here. Then I'll break into the IRA section of the presentation. This is just an old property here that we continue to do very well on. It was a 5-unit near Rutgers University in Newark, New Jersey, and smaller property here, but we did buy it and refinance it within a year and made back the entire investment for the investor. We bought it for $110,000. They were asking $130,000. Put about $30,000 in renovations into it, which is a very small amount for a 5-unit building. And we captured some equity right off the bat, but then about a year later, it refinanced, appraised for $310,000. So we were into it for less than $200,000, and that allows us to pay back our investors' entire initial investment and continue to get ownership of the property there. And he continues to cash flow to this day. We actually refinanced it again a couple of years later in 2017, and he continues to make a little bit of cash flow and be a nice producing asset there. But just goes to show a good asset, a good area, well maintained. Not a whole lot of investment off the bat. Continue to be the gift that keeps on giving. Now, not every deal like this, of course, we're going to get back our initial investment in the first year and a half here. But a good example here of a great deal in Newark here near Rutgers University. Here's another example of a property we actually bought and sold. This is a 25-unit in South Jersey. And we learned a lot through this investment. We hired a couple management companies and fired them. We developed our own management company. We realized the most important thing in real estate is the management company. It doesn't matter if you're invested in North Jersey or South Jersey or Texas or Miami, mixed use, apartment buildings, there's all different types of ways to invest in real estate. But if the operators don't know what they're doing and they're hiring the wrong management company that just looks at your property like a number on a screen and doesn't take care of it the way you'd want it to be taken care of, then you're not going to succeed. Real estate is all about management, good management, heads up management, professional management of real estate for a good price as well. And so in this situation, we bought the property for $1,075,000. They were asking $1.2 million. So we were able to get about $125,000 off the bat, right there. We secured a bank loan for 75% of the purchase price at about a 4.5% interest rate. These days, we're getting properties at around 3.5% interest rates. So this was back in 2014. And then we sold it about 2.5 years later for a nice profit. We achieved our target goals. Our investors earned around 10% cash and cash return on their investment. We sold for $1.35 million, and we did a 60-40 split on this investment. Generally, we're anywhere between 70-30 to a 60-40 split on the investments, with the investors getting the majority ownership of the property. We do not charge an assets under management fee, which is what a lot of syndicates do. That's a fee based on the amount of funds raised. We do not charge that. And we also do not charge any type of ongoing fee for management of the property aside from the property management fee, which goes to the property management company, which we have to pay anyway with any property management company, of course. So we run a equity-based structure here, equity-based fund. We really go for performance, Seth and I, to put food on our own plate. We think that's important, that for us to eat, we need to perform. We need to be achieving cash flow, refinance targets, and that allows our investors to earn nice returns and us as well. It's important to have a win-win structure with any syndicate like that. So let's talk about self-directing your IRA or solo 401k. So the first step in self-directing your IRA is selecting the IRA custodian. Now, there's over 50 of them out there. They're all a little different, but they all pretty much do the same thing. They allow you to take your IRA from wherever it is. You'll contact that company. You'll tell them how much you're looking to move into the custodian, into the self-directed IRA custodian. So they'll contact, let's say, Fidelity, where your IRA is right now. You'll say, okay, I want to move $50,000 from Fidelity to Alto IRA. Okay, so that's one example of an IRA custodian. So Alto IRA will contact Fidelity, and the Fidelity will move over the $50,000 to Alto IRA. Alto IRA will ask us for the documents, the operating agreement, any LLC offering memorandums, private placement memorandum, the LLC formation, the EIN for the LLC, and any other documents they require at that time. They'll take a look at them. They'll likely need to execute them. And then you, as the IRA holder, will also need to initial it, most likely. And then the IRA custodian will wire the funds to the operating account or the title company or whatever account is selected for that investment. And then as the property creates cash flow, we're going to send those cash flow checks back to your IRA custodian. When the refinance happens, we'll send that back to your IRA custodian. So you can't take the money early. It's not a way to cheat the IRA system, but it is a way to take your IRA, move some of it out of the stock market into actually professionally managed real estate that produces cash flow and equity growth over time. And the idea is to diversify some out of the stock market so you can sleep a little better at night and ideally be prepared for any market headwinds as well. But the process is quite easy. It costs between $50 to $250 to open an account. It costs about the same in annual fees, depending on who you choose as your IRA custodian. And if you're not sure, maybe you have a number of 401ks, you're trying to roll into one solo 401k. We deal with that a lot. Maybe you have a couple different IRAs or a SEP IRA, and then the Roth IRA. So a lot of different moving pieces there. Then you might want to talk to Alan. I just forgot his last name. We work with an individual, Alan Johnson, and Alan Johnson has been in the IRA industry for years. And he's not an IRA custodian, but he just guides people on selecting the right IRA custodian. He has a tool that we can actually, it's generally, I think, $25 to use, but we have a code that you can use this tool for free. So if you want to get that code, you can get in touch with us after the presentation here. So that's Alan Johnson. He's a great individual to connect with, and he can help you select the right IRA custodian for your goals. And if you want to save that $25 for his system, then let us know, and you can email us at info@peoplescapitalgroup.com, and we'll send you out that discount code so you can access his information there and select the right IRA custodian for your goals there. But that's it for self-directing your IRA. It's pretty simple. You really just need to select the right IRA custodian, select the right real estate syndicate, and then, make sure your real estate syndicate, of course, is IRA friendly. knows how to work with IRA custodians and knows how that process works, knows what your IRA custodian is going to look for. They're a little difficult sometimes. They don't do the electronic signature and things like that. So we're very IRA friendly, very solo 401k friendly. I've worked with dozens of different IRA custodians. They're all a little bit different, but they're all pretty much the same. So we suggest a few different ones. I like Auto IRA a lot. I like Next Generation Trust. And those are probably my two favorites. Yeah, I mean, but there's so many out there. They're really, you just want to take a shop around a little bit and find the right one for you. As far as the end of the year goes, we send the K1 out to you and your IRA custodian at the end of the year. It'll be made out to your IRA custodian's EIN. And of course, the funds roll back to your IRA and continue to grow your IRA. And then as we do that refinance, most investors take that refinance capital and reinvest it in whatever opportunity we have at that time. And that's how most investors work with that refinance capital as it comes. So yeah, if you want to connect with Alan Johnson, we can definitely help you do that. And he's the one to help you self-direct your IRA or solo 401k there. So here's 3 types of investors we work with, and then I'll wrap up for the evening and answer the questions that are coming in. So we work with 3 different types of investors, primarily accredited investor. These are high income investors that generally have a large stock portfolio or a large amount of wealth, and they're looking to self-direct some of their IRA or solo 401k into real estate. Real estate offers cash flow, which is similar to dividends. However, cash flow can be written off with tax depreciation. If you're investing through an IRA, of course, it's all essentially a wash anyway. But the idea here is to have more predictable long-term returns and be more recession resilient as well, and not as volatile being solely invested in the stock market. We also work with active real estate investors. So these are people that already own properties. Maybe they're running around managing a couple smaller properties. Maybe they're dealing with a management company and kind of pulling their hair out sometimes and not getting the results they're looking for. Or they're just ready to kind of check out what it's like investing with a syndicate and see how well they could do there. So we, of course, manage the property day in and day out. It's a much different experience working with a syndicate. You get your monthly updates, quarterly financials, quarterly cash flow check. You don't have to do anything except go to the bank and deposit your check. And we're even working on that now with direct deposit. So essentially, it's a very passive position. It's very different than being a landlord, which is a full-time job if you have enough properties. And I found that out the hard way. So again, they're usually on call being a landlord, but you're never on call with us. Buying bigger units allows investors to get into bigger properties, which are safer investments and tend to be hindered less by vacancies and repairs. And of course, come tax time, it's much easier to work with our group here. We have the K1, we have a whole separate CPA firm, bookkeeping firm that does all of our tax prep, and that allows us to get our K1s out to our investors in a timely manner and make sure that our financials are very accurate and that our tax filings are done in a timely manner as well. Make it as easy as possible, make tax time as painless as possible for our passive investors. And of course, the final type of investor we like working with is an IRA investor. About a third of our investors self-direct their IRA into real estate with us or solo 401k. And that allows for getting out of the stock market a little more recession resilient, but also seeing your IRA make a difference in a local community like Newark or Patterson or Rahway, and seeing those funds actually go into mismanaged buildings, making them better places to live, safer places to live. And maybe you grew up around those cities and maybe you really want to see those cities do better. And that's a nice thing to see. And that's why people tend to like investing with us that are local as well. And they know the cities. It's really nice. Most groups are not doing New Jersey. So that allows them to get into New Jersey properties here, feeling confident in the investment, confident in the operators. They know the market. They know it's a high demand market, and they know us. They've seen us around here for a decade or so they know we're the real deal. All right, so here's a couple client satisfaction here at Tim Carey, 5-time investor. I continue to grow my investing relationships with People's Capital Group. They have a great history of buying properties at a good price and offering value. That's our job. Frank McCuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. And Chris Salerno, 6-time investor. I've invested with People's Capital Group for nearly 5 years now. Cannot be happier with the process and the returns on my investment. Aaron and Seth and the rest of the crew are fantastic to work with. They're like clockwork in their updates, communications, and payments. A great company. So thank you very much to our investor group. We have over 50 people that invest with us, and 9 out of 10 people reinvest over time. You can learn more at peoplescapitalgroup.com, and that's actually our website right here. We have so much information here. We have FAQ, but also go put your mouse over the value tab, and click on all the information here. We have a blog that we put new blogs up every week, recorded webinars of past webinars as well, all different topics there. If you missed a topic in the past, it's all on our website there. And then my podcast, the Passive Cash Flow Podcast, we do that every single week. So you can check that out on our website. You can check out any offerings, our ebook as well, and sign up for upcoming webinars as well. So that all happens at peoplescapitalgroup.com. So check it out. And if you like what you see, you can fill out a form to qualify to invest. And that's the first step in self-directing your IRA into real estate with People's Capital Group. All right, so let's see here. We have some questions. Jem Lynch, I don't understand your question, Hootie. I don't know what you mean by that. Hootie and the Blowfish is what I'm thinking. No, and there's an art center in downtown Rahway. I'm not sure if Hootie's playing there. Okay, so here's what we're looking at. Here's a question from the crowd here. Do you offer properties outside of New Jersey? No, we focus on New Jersey. We stick to what we know. We have been investing in real estate long enough to know when you have your boots on the ground, your infrastructure in a market, you know the market well enough. We have all the broker connections here, the wholesaler connections. It'd be silly to go to a different market. We have dabbled in Vermont here with a number of short-term rentals, but the grass is always green on the other side. We found that actually what we have in New Jersey is a great infrastructure, and managing and owning apartment buildings in North Jersey is a better investment than a lot of other markets. So we don't do any properties outside of New Jersey for the time being. We stick to what we know, and we try to really perfect our systems here in New Jersey. So Jim Lynch, you have a question, how much per year? So as I was saying, our investments tend to produce around 10 to 11% cash on cash return when annualized. So historically, we've hit that target, and that's generally our target on our offerings. That's a combination of cash flow that comes quarterly, but that's really only about 20% or 10% of the returns. The majority of the return comes from the refinance, which is where our investors would expect about half of their investment back. And when you break that out annually, that comes out to about a 10% cash on cash return, or maybe about a 15% internalized rate of return, counting your tax benefits. Okay, so here's another question. What's the returns of the IRA? So the returns with the IRA are same as the returns with a cash investment. There's no difference. So yeah, what I said there, the 10% cash on cash return annualized, about a 15 to 17% internalized rate of return. Those are our targets. We try to do better than those targets, but of course, we want to set the bar at an attainable level. And historically, we've either hit our targets or done about 10 to 20% better. So any markets suggested to the south? Here is another question. You mentioned investing near your home. I'm in Houston. So I really don't know much other markets besides New Jersey and Southern Vermont. Those are the two markets I own real estate in. So I'm not the person to ask for investing in the South. I know a lot of other syndicates focus on the South, Texas, the Carolinas are very popular. I've seen, Tennessee. So yeah, I mean, the South is good for cash flow. Although Houston, Dallas area probably so high demand right now, you're probably almost similar to the prices you're looking at in North Jersey. I know the Dallas Fort Worth area is like really high priced right now, so I'm sure Houston is not too far behind. But yeah, so we don't really focus on those markets, but I know people invest in the markets in the South for cash flow. We focus more on equity growth. We have a very long-term view of real estate. Also, the way we pay ourselves with the cash out refinance to the equity growth is a great tax strategy for our cash investors. So if you have a question about New Jersey real estate, I know that market like the back of my hand, so I'm the guy to ask for sure. Okay, no problem. All right, thank you so much. It looks like those are all of our questions. Oh, here's another one. How do you manage with the rate of the property taxes, especially in North Jersey? Well, it is a pain in the neck, property taxes, right? We really try to deal with property taxes as best we can. We have a building right now, a 25 unit in Patterson, New Jersey, where they just raised the property taxes 15%. Now that's because we just bought the building last year, or just the year before that, actually. So that caused the taxes to go up, and it shouldn't happen again next year. But still, that's a big challenge right there. Now, luckily, we assume that for every dollar we increase rent by, that taxes will go up 50 cents or expenses will go up 50 cents. So again, when we're analyzing a building, if I can increase the rent by $1, then I assume my expenses go up by 50 cents. And that's a pretty good assumption for the growth of taxes. As far as what the taxes are right now, when I'm underwriting a building, well, of course, that's a number we're going to punch in the spreadsheet, and it's just all relative. You're collecting more rent in North Jersey. So you might be paying more taxes, but your rent rolls higher. So it's all relative, and we also try to do tax reassessments as well, if that makes sense. Here's another question. Do you focus on areas offering abatements? We've bought near areas that offer different tax abatements. We've bought near different growth areas with the that special tax law in place that allows for writing off your taxes long term. We don't really focus on always buying in tax abatement areas or trying to get tax abatements, because that's really for new construction. A lot of times that's not so much for existing real estate. We focus on buying existing real estate. We do try to get our taxes lowered by getting a tax reassessment, but sometimes you'll reassess it higher. So you don't want to make that mistake. So we really focus on only doing the reassessment if it makes sense. Okay, one more question here. So we have, what are you doing with storage facilities? We don't actually own any storage facilities right now. We're definitely interested in acquiring some. We like the numbers on them. We like where that area is growing. And we're definitely looking to possibly get into that space in the near future. But again, people are always going to need a roof over their head. You better bet people are going to pay for their rent for their apartment before they pay for the rent for their junk. So we feel that apartment buildings are a little more tried and true, but rental facilities, storage facilities could be a good thing to have in your portfolio for sure. We'll definitely keep our eyes open for that. All right, so it looks like those are all the questions here tonight. So guys, if you have any more questions, you can go to peoplescapitalgroup.com. Okay. Oh, here's another one. Sorry. We've got a lot of questions here. So we have focus on the IRA here. Oh, can you explain the refinance part of the investment? So the refinance part of the investment is quite simple. So what we do is we increase the value of the property by increasing the rent roll of the property. And therefore, the property makes a stronger net profit, net operating income. And just like a business, the more profit a business makes, the more it's worth. So the more profit an apartment building makes, the more it's worth. So therefore, it increases the mortgage on the property, increases the value of the property. And now the mortgage on the property, of course, we're going to go and get a higher mortgage, a larger mortgage. So the property is worth a lot more money and it makes a lot more cash flow. So it can afford to get a better mortgage, a higher mortgage amount, of course, still at a low interest rate. And that's going to allow us to pay off the old mortgage and have cash left over in between. So for example, if I buy a property for $1 million, let's say I put $200,000 into it, and now the property is worth, for numbers' sake, $2 million. So now, because the property is making a lot more cash flow, it's worth $2 million. So now I'm going to go to the bank and I'm going to get a mortgage for $1.5 million. Well, I bought the property for $1 million. I put $200,000 into it. So I'm into it for $1.2 million. The new mortgage is $1.5 million. So there's $300,000 left over after that cash out refinance. So that allows us to then distribute that cash to the investors. Now, remember, that's debt. That's debt that our property is going to pay down for years to come. It's low interest debt. It's a safe amount of debt. The bank's not going to give us more debt than the property can handle. But since that's debt, that's tax-free money back to our investors. Now, if you're investing through an IRA or Solar 401k, it's tax deferred regardless. But of course, it's a tax strategy overall for our investors. So that's how the cash out refinance works. If you still have more questions about that, you can email us at info@peoplescapitalgroup and we can send you more information, or you can go to our website there and fill out a form. So it's another question. Do you focus on investments in the OZ or affordable housing, multifamily? We actually own a property in affordable housing. We don't like it. We actually are selling it because affordable housing is very difficult to lease. You have to get it's really poorly done. It's not a good system. The way it works is the people come and look at the unit. You have tenants that apply. You pick the best application. Then you send the application into the affordable housing center that underwrites them. And they have a certain amount of time to fill out the paperwork and get underwritten for affordable housing. What we found was that 90% of those applicants wouldn't cooperate with the paperwork, and or wouldn't qualify for affordable housing. So we do the open house, get all the applicants, and you could only submit one applicant at a time to get approved for affordable housing. So we'd be waiting around for the approval. They would get denied or they wouldn't cooperate. That would be a week and a half, and then we'd move on to the next one. But of course, the next one would have found a different one. So it was really a headache. Affordable housing, of course, you're limited to what you can charge in rent. And we found that to be more trouble than it's worth. Now we're selling the property for a nice profit here. That's what we're working on right now. So that's the magic of real estate. Even if you run into headwinds with leasing or headaches of management, a lot of times the property is being managed property and being bought for the right price in the right markets. You can always sell them for a nice profit. And that's always plan B for us on our investors. Opportunity zones, we don't focus on. We buy around opportunity zones. We see a lot of growth around opportunity zones and in opportunity zones. Buying in opportunity zones is really expensive. You have funds with tons of money trying to get into there. So we don't focus on that. We just buy around them because a lot of the real estate around opportunity zones tends to really flourish over time because they're doing so much development in the opportunity zone. Here's Sabrina, will you send a copy of the presentation? Yeah, Sabrina, so I can send a copy of the presentation out to everyone. You should get an email from Zoom that'll put you to our Facebook group. But you can just go to our Facebook page and go to our Facebook group, go to Real Estate Investments on Facebook. That's our page. And then People's Capital Group is a private group on Facebook. So check us out there, People's Capital Group on Facebook, or just go to peoplescapitalgroup.com and fill out an application form. So again, if you want a copy of the presentation here, you can get that on our website. And you can also get it on our social media there. If you want a copy for yourself there, you can email us at info@People's Capital Group. Or go to our website, click this button here, qualify to invest. That's going to bring in this qualification form, simple to fill out. And then we'll contact you once we have this form. And you can set up a call with me, Aaron Fragnito, if you're qualified, and we'll talk about your investment goals and what we have available right now. And that's the steps to get qualified and get invested there with People's Capital Group. And all right, great. Looks like I've answered all the questions here. I had a lot of questions tonight, which I love to see. So thank you everyone for jumping on. We had a great turnout. A lot of people looking to self-direct their IRA into real estate with People's Capital Group. So check us out on our website, peoplescapitalgroup.com. Hope you enjoyed our presentation tonight. And this will all be on our social media as well. You can check us out there on Facebook. Thanks a lot. Have a good one.